have one more special guest for you. I'm happy to introduce Chase Hudson, and he is with Sahouri Insurance. Sahouri has been in business for 50 years. Chase has been in the business for 7, and they specialize in community management risk, advisory services. So welcome, Chase, and thank you for joining us today.
Thank you for having me. Appreciate it. So today, want to go over for what's most valuable to board members, right? So I want to go over Community Association 101, right? What policies you need, what is the most important. Now, there's going to be 5 policies that every community is going to need. And I want to go through what they are, what are the most important coverages, and what to expect, and then give you guys just kind of an update on the market, because we are seeing a change in the current insurance market. So everybody's aware. You see what to expect in terms of rates and carrier placement. So we'll jump right in, and we'll start with what's called your package policy. Your package policy is going to be the brunt of your insurance premiums per year. And within a package, we call it a package because there's 2 parts to it. One is going to be your general liability, right? So your general liability is covering the association's liability. And general liability is third-party bodily injury and property damage. The most common, by far, general liability claim we see within community associations is going to be a slip and fall. Someone slips and falls on the common area, they file suit against the board for their injuries. I mean, not against the board, against the community. And that's when your general liability is going to kick in. By far, most common claim within community associations. So it's your general liability. You're typically going to see the average and the standard limit on your policy is going to be $1 million per occurrence and $2 million aggregate, meaning for each occurrence, for one slip and fall claim, you're going to have $1 million dedicated. That's, and that includes your legal fees and everything like that. And then 2 million aggregate, right? And I'll get into it. An umbrella comes in a little later, which is additional liability coverage. The second part of your package policy, whether it's HOA or condo, is going to be where I would say the most premium generating coverage, and that's going to be your property coverage. And that's because the carrier is responsible for replacing that property with like kind and quality if something were to happen to that. For example, your condos, pretty easy. Your condos are the building. That's the property. And that's why condominium insurance is going to be much more expensive than a HOA insurance, because you're insuring the actual building. All the assessments are going towards that insurance policy to cover the replacement of that building if, God forbid, something happened to it. So if unfortunately a fire happens, that's what your property is going to kick in. And your building limit, each policy is going to have a building limit. And that's going to be the limit that the carrier pays out, right? So you want to make sure that your building limits are adequate. One of the things I'd like to point out right now is in this current market, I'm sure we're all aware of the increased cost of construction, the supply chain, and how, look at lumber. Lumber has skyrocketed over the last couple of years. So your building value should be increasing a little bit more this year, and that might generate some premium increase. Now you might say, oh, well, why is my premium going up? Well, if you look at the building value, your premium is based on that building value, because the carrier is going to have to pay out if something happens. So something to keep an eye on is your building values with the current market. For HOAs, it's a little simpler, but your common property, your tot lots, your tennis courts, or your clubhouse. If your community, your HOA has a clubhouse, that's going to be the largest property factor of your policy. Any pavilions, if you want to insure your mailbox clusters, all these can be added to your property coverage. So with your package policy, I want to keep things nice and simple. That's why you have an agent, right? If anything crazy comes up, you call your agent and they can break down everything for you. But so package policy, general liability covers the liability. If someone, files suit against your community, property is covering any property that's commonly owned by the association, whether it's an HOA or a condo. A couple property coverages that you just want to, when you're looking through your policy, that you want to keep in mind that I call the big hitters that you just want to make sure that they're included, because there's a standard form when it comes to insurance policies. But you want to make sure that you're having a few of these coverages in there because there are commonly filed claims, right? The number one that is an added coverage is going to be your sewer and drain backup coverage. Now, I don't want to get you guys too confused on all these different coverages, but sewer and drain backup, if there's a backup that's rooted from your sewer line, say it makes a toilet overflow, right? That's a coverage that you're going to want on your policy, because a lot of the standard policies have a $5,000 limit, $10,000 limit, but we are seeing more and more sewer and drain backup clogs that go up to 25, 50,000. I recommend a limit of 50,000 for your sewer and drain backup minimum, you know, and every carrier and agent is going to have a different base limit, but that's, if you're looking at your policy as a board, you want to have at least about 50,000 in sewer drain backups, because they are commonly filed claim. Second, if you have older buildings, especially, there's coverage called building ordinance or law. So building ordinance or law, the easiest way to explain it is if you have a building, it's older, burns down, the carrier will rebuild your building with like, kind, and quality. However, if there's been any laws passed, ordinances that require you to rebuild your building, but you know, say there's new sprinkler systems that you need to, and your old building didn't have that, or wheelchair ramps to be compliant. The carrier without this coverage will give you what you need to build with like, kind, of quality. If you don't have this coverage, that's all you're going to be on the hook for that. So I always recommend making sure that you have your building ordinance or law coverage included, right? Lastly, your common area business personal property. If you have a mid-rise or anywhere with a lobby area, you want to make sure that all that furniture and stuff is covered. When you think of business personal property, think of, you take the building and you flip it upside down, what would fall out, right, in the common areas. Now, inside your unit, you're responsible for your own personal property, and that's going to be covered on your HO6 policy if you're in a condominium. So you're going to make sure that your TVs and your sofa, you have a limit for your own property. But making sure you have sewer drain, ordinance or law, and your business personal property are three quick hitters I always like to say to boards. Make sure you have those coverages. So that's your package policy. Now, for you, the board, most important coverage for you is going to be your D&O, or directors and officers coverage. This coverage is there to protect and defend you as the board when decisions are challenged, or if you're accused of failing to meet your responsibilities, right? Another word they use for D&O is wrongful acts coverage. I think we all know the importance of having this, right? If anyone's coming after the board saying that you didn't do your job, and we understand your volunteers here, so this is there to protect you. And some of the things that you want to look out for when it comes to your D&O policy is we at Sahouri are always going to recommend what's called a standalone D&O policy versus one that's included as an endorsement on your package policy. Now, what's the difference? Well, you're going to be paying a lot less when you just add an endorsement to your package policy, because you're going to be getting a lot less coverage. For example, you know, when you look at D&O claims, the common D&O claims are claims that someone is wanting financial compensation because the board did X, Y, or Z, right? So board made a decision to hire a new tow company. They towed a bunch of cars. Unit owner comes, sues the board saying, I wasn't made aware, anything like that. They're requesting a financial compensation from a board's decision. But there's also situations that we call non-monetary damages. When a unit owner isn't looking for any financial compensation, they're looking for maybe a change in a rule. You know, example of, I wanted to fly this flag, and the board said I couldn't, and I don't want any financial compensation. I want to be able to fly my flag. Or the board implemented a dog breed restriction. But when I first moved here, we didn't have that. So I want to be able to have this type of dog. That's a non-monetary claim. And so you want to make sure that your D&O coverage has these non-monetary damages. Sometimes when it's included as an endorsement on the package instead of its own standalone policy, it will be excluded. Another big one that we see is excluded on some of these endorsed D&O policies are discrimination. Someone claiming that the board was discriminatory against them. A lot of times it's excluded on the packaged D&O and included on, it's going to be always included if you have a good standalone policy. Standalone versus packaged in terms of pricing. When you add it as an endorsement, you'll typically pay in between $250 and $500, depending on the amount of units. D&O policies are rated on the amount of units per community because there's that much more likelihood of something happening, right? So when you have a standalone policy, they typically start at around 800 and go to up about 3,000 to 4,000 if it's a really large community. But when you have a standalone policy, you as the board are going to be protected. And there are carriers and programs that anyone who's involved, we're heavily involved in CAI, both local chapters. And there are D&O carriers and programs that are endorsed by CAI. So this product is specifically for community association directors and officers. Any of those they're gonna cover for what should be covered. Yeah.
Coverage for board members and committee members and the spouses of these members, is that?
Yes, that's a great point. So committee members are going to be included on a standalone and sometimes excluded on a package D&O.
And spouses.
Yes, yeah, and appointed, and I'm trying to think here.
Everybody that is in a decision-making or recommendation-making capacity?
Mostly, yes. I mean, each policy is going to specify that, but another great coverage just difference between a packaged and packaged and standalone is going to be failure to procure and maintain insurance, right? So if you, the board, are responsible for making sure that your policies are in good standing for your community, something happens, there's a lapse in coverage and there's a fire, God forbid. There's a fire, that unit can't be rebuilt because there was a lapse in coverage. They're going to come to the board and say, hey, why wasn't this in place? A standalone coverage is going to protect you. Typically a package unit is not. And so those are some quick hitters on the D&O coverage. Just something to keep in mind. I know it's a lot. I forgot to, when I first started, like, who's excited to talk about insurance on Saturday morning? Right? Yeah, it's everyone's favorite topic. All right, next. Your next policy that every community is going to want to have is your crime policy, or other known as fidelity. This coverage is, we keep it simple here. It's to protect your community's assets, right? You want to make sure that if something happens, if those are stolen, the main coverage for crime or fidelity is what's called employee theft. And crime policies are built for businesses too. So when you hear the word employee, think board member, right? So you as a board are going to be considered an employee. It's just the terminology used. So if one of the board members decides to steal all the reserves and run off to the Caribbean, this is where that coverage is going to come in, and you're going to file that claim. It's a property coverage. You file the claim and you'll be reimbursed for that. That's where that's going to, the one thing to know when you're looking at your crime, well, what limit should I have, right? I'm a condominium board. What limit should we have? So we always recommend at least keeping up with the FHA loan requirement limit. The FHA is always going to require this limit, and that's going to be your total reserve plus 3 months assessments. Now, you're more than welcome to ensure your full year assessments. I will say that while this claim does happen, it's a very infrequently filed claim. It doesn't happen quite as much, but you want to just make sure that your limits are correct so that you're not getting any calls from FHA saying, hey, increase your limits or else we won't give you this. So that's going to be your crime policy. Next, circling back, is your umbrella policy. Now, your umbrella, as I'm sure you guys are familiar with your personal lines or if you own a business, it's additional liability limit, right? We're going back to when I said your per occurrence limit. There's a slip and fall. It's a really bad slip and fall. This person got really hurt, and between legal fees and the cost to help them with their surgeries and everything, it's adding up. Your per occurrence limit is $1 million, right? Claim ends up being 1.2 million. Where's that 200,000 going to come from? Your umbrella is going to kick in as soon as that per occurrence limit is exhausted. One thing to note about umbrella is you want to have an umbrella that extends over your D&O as well, right? So if your D&O limit, typically $1 million is the standard D&O limit. If that is exhausted within a year, then your umbrella extends over your D&O too. Sometimes it's only extending over the general liability. I always recommend an umbrella policy that extends over your D&O too, so you don't, just peace of mind, you've got your D&O extended as well. The umbrellas are very simple when you're coming to that. They're there as a safeguard. A lot of times it's not going to be used, but they also are priced that way, right? They're typically very affordable. I'm going to go into a little bit of umbrella markets that we're seeing right now when I get into market updates, but that's your umbrella 101, when you're looking through it. So we've got your package policy, general liability and property. Got your directors and officers policy to cover you guys. Got your crime policy to cover your community's assets, your umbrella, extended liability coverage. And lastly, which is we always recommend it. We see communities who want it and communities who don't, but basically it's going to be an if any workers' comp policy. So most of the time communities do not have employees, right? And if any workers' comp policy is typically going to run between $400 and $600. It is a more affordable coverage. Some boards say, well, we don't think we have that exposure, or, we recommend it just to be fully protected. And that policy is going to cover you in the event that the easiest example is you hire a contractor to do some work. You make sure that you get on the work is to be done on Saturday. On Friday, you say, please provide your proof of coverage that you're insured, your certificate of insurance, saying that they have their own insurance in the event that something happens. But on Saturday, in between Friday and Saturday, that coverage was canceled for non-pay or for any number of reasons. Contractor gets hurt, come back and say, hey, I'm technically working on behalf of this association. That's when this policy is going to kick in. And when you get an if any workers' comp policy from a specialized carrier in this industry, also some that work with CAI, we work with a couple that are made just for community associations, they're going to include volunteers. And that's a big one. When you're having a volunteer during doing some work for you, they hurt themselves and they say, hey, the community hired me to do this, or I volunteered to do this on behalf of the community. The volunteers are not excluded on the if any workers' comp policies that are run through, that are specifically for community associations. So that's your 5 policies that you're going to want to review. Again, that last one, if any, sometimes communities want them, sometimes they don't. I just always recommend it because I'm a risk manager, try to make sure that you don't have any additional liability or claim scenarios that wouldn't be covered. So to finish up, I want to give you an insurance market update. And the insurance market, well, about 2 years ago, entered what's called a hardened market. And a hardened market means carriers are increasing rates and their appetites are getting slimmer. So when you look at why is the insurance market hardened? Well, if you look through the last 10 years, all of the natural disasters, domestic terrorist attacks, these are all claims that end up happening, right? So Hurricane Harvey in 2017 in Houston, they had $2 billion worth of losses, right? Just from that. The domestic terrorist attack from Las Vegas, I think was like an $800 or $900 million insurance claim. Now, all these carriers are tied together, right? It's all one market. When you see, it's kind of like, think about gasoline. When gasoline's going up, it's going up all together. Between all that, the wildfires, everything, and then COVID hitting, we really hit that hardened market. And so that you're going to see increases a little bit more than you would before that. You know,
Surfside.
and Surfside, yeah, I was just about to say that. So Surfside, that's a great point. Surfside scared carriers out of the market. And so again, this is our specialty. We work with carriers who specialize in community associations. We have 2 umbrella markets that completely withdrew from the community association market, meaning this was their bread and butter. They were endorsed by CAI. Now, because of everything else with the hard market and then Surfside, we had 2 carriers who were just no longer, they're non-renewing all their policies. They're saying, you know, we're not getting involved with this. So that was a great point. And Surfside really was a nail in the coffin for umbrella markets. And it's not just the umbrella markets, you know, going back to COVID caused a lot of that supply chain issue. And so you are seeing everything, the increased cost of construction and lumber and building materials are just they're gonna increase your rates. Now, the numbers I like to use is before the hardened market, if you had no claims in your community, you'd probably see an annual increase to adjust for inflation in between 1% and 5%. That was the norm. Now we are seeing anywhere from 4 to 20%, depending on the risk. And again, fewer carrier options also make it a little bit more difficult. I think it's getting better. You know, I think the umbrella market will sustain itself. But just when you're looking at your renewals and if you've been board members for a long time, it's normal that they are going up. Now, if it's exponential, maybe talk to your agent and see why, get that info. But just as a whole, the market has changed. Any questions? Yeah, first in the back.
Yeah, could you go back? You mentioned recommended policy. You mentioned, you gave an example of a higher contract for work. Could you explain that?
You
mentioned the fact that workers' compensation.
Yeah.
You mentioned you provide an example there. Can you give an example of workers' compensation when you said that the contractors and the volunteers are responsible as well?
Well, so with any business, you're gonna have workers' comp, right? If you get hurt on the job, that's gonna kick in. But what I was saying was an if any policy is there's no scheduled payroll because the community doesn't have any employees. It's strictly there in the event that someone is hired or volunteers on behalf of the community and gets hurt, and they're not covered by their own policy. So if you have someone fixing your streetlights and they fall off the ladder, you check their certificate of insurance the day before they did the work that showed that they had their own workers' comp coverage in the event of them getting hurt. But in between that day, they no longer have coverage. They're badly wounded. They can't get the funds to help pay their medical bills. And they come after the community saying, hey, but you were technically sometimes they can, hire a lawyer and try to get the community to pay for it. This policy would help the community pay for that in the event that happened. And a lot of boards think, well, that's, we're making sure that all of our vendors are properly insured, and sometimes they opt out of that coverage. But I just say it's an extra precaution and a policy we recommend to be fully protected. Yes.
So can you just tell us who the three biggest insurers in this market are? And tell us a little bit about your insurance company. What are the advantages of your company? Because I've never even heard of your insurance company.
Depends on the line of coverage, right? So within your package policy, again, it's going to be the brunt of your yearly insurance premiums. There's a lot. We work with 20 plus carriers that we place, and it all depends. So that's a really tough question, because I can go on and we have an answer for kind of everything, right? A high-rise condominium in DC, we might place with one carrier compared to a small HOA in Lintico, right? So to give you a few carriers that we work with, Greater New York is a carrier that we work with that specializes in community associations. E&H Graham, who is a program that uses QBE. They do a really great job with community associations. We work with Erie Insurance. We insure hundreds. They have a really great product on condos and HOAs as well. I could go on and on. As for Sahouri, well, you're getting a specialist, right? So, and you're getting an independent agent, going back to these different carrier options. So unlike what's called a captive agent would be an example, and nothing against them. It's just, that's what they are. It's State Farm. State Farm's a captive agent. So they use State Farm only. Whereas Sahouri and some of my other competitors, we're independents. We have access to multiple different carriers, and that helps with, in the event of a claim, if that wasn't handled well, we can move to a different, or if we see an unjust increase in premium from one carrier, we have options to move. So we're an independent agency, and we specialize in condos and HOAs. We insure over 500 communities in the area. We really, really pride ourselves on our customer service and the integration of technology that we use. We've heavily invested in technology to keep us ahead of the game. But I'm not here to talk about Sahouri. I'm here to talk about the great job American Community Management does. Sure.
How often should HOA insurance services be rebid, or how often should the HOA rebid for insurance services?
Great question. So rebid, I would say they should look at it every 3 years, right? And if you have a good independent agent, or if you just have a good agent, right? And they're making sure, and I say independent because they can look at different carriers themselves. We do in-house. So every year, 90 days before your renewal, we're looking at what's going on with the market. We're talking to the carrier. Are we going to get an unjust increase? But the reason we say 3 years is you do want to have some consistency for one major reason. If you're moving carriers every year, when you come back to us and you say, oh, well, we want to bid this out again, right? We want go to another carrier. Let's see if we can find better. Well, we send it to the next carrier and the carrier goes, well, they've moved every year. Like, we want to retain the business, the carrier will say, and so do we. But that's one of the things why we say every 3 years. If you do right 1 year and you get a 30% increase for no reason the next year, yes, maybe that's an example of when you're going to want to look into other options. But depending on whether you have an independent agent who can bid out themselves and you trust that agent. My clients, I hope, trust me to know that, Chase, can you look, we do it automatically, but can you look into other options? Yes, we will do that. Or if you want to get different quotes from different agents, that's another way of going about it. But 3 years, I would say, is when you're going to want to look at it, unless something sparked a reason to change before. Yeah.
Tell us about your risk management assessment when you're trying to offer coverage for a new client.
So yeah, so when we're looking, if we've got a new opportunity to provide a proposal, we're going to look at, your building. We're gonna make sure that your building values are adequate based on estimated square footage and cost of construction. We're gonna make sure, we'll look at what, I always like to do an audit and make sure, hey, what do you currently have? And then I provide a coverage comparison to show you what you currently have versus what we're gonna provide. But you use the word risk management, which I think is very important for when communities do run into claims. When you run into a claim, when you have a large loss, your rates are going to go up. But you're going to want to make sure that you're working with your agent on a plan, and that agent should be offering it. It's what we do every day when we have communities, or we're trying to work with the community that has had a lot of losses. They've had 5 sprinkler leaks. Well, when you're trying to shop that policy to a different carrier, that carrier is going to look at it and say, 5 water leaks, what's going on here? And if nothing's done, you're not going to get better pricing. You're going to stay where you are because the other carriers don't want. So we implement a risk management plan, work with you, your manager, you and the manager, to work on what is happening. Why are we having losses? What can we do to avoid losses? Is it a sprinkler leak? Is it HVAC systems? Is it a huge roof loss? So depending on your history, we're also going to look at the age of the buildings. Are everything in place to make sure we're avoiding a loss? So having that agent to work with you closely is very important.
One more question.
Sure.
We'll wrap it up. Is there any benefit of getting an independent assessment of replacement costs as opposed to just accepting insurers' valuations of buildings?
Yes, absolutely. So that's a great question too, because different carriers are going to have different values. Cost of square foot of construction, that's going to be, the differences. Some say, well, right now with lumber, we need to put it at $150 per square foot. And others will, well, we're at 140, right? So the answer though is if you get a appraisal, a formal appraisal, and a lot of boards don't, or communities don't, because they can be expensive. But a formal appraisal is going to give you the black and white answer. I mean, I'm very confident with our appraisal, with our in-house valuations, and then we determine the valuation, we see what you have. If it's really low, we're gonna say, no, this needs to be increased. Then we send it to the carrier. The carrier's gonna review because they wanna make sure that those limits are adequate too. But if you are worried about that, a formal appraisal is going to give you the exact number. There's also, sorry, 1 second, there's one thing that you can add to your policy, which kind of gives you that buffer and ease of mind, which is an extended or guaranteed replacement cost endorsement. So most policies, the standard policy is going to be written on 100% replacement cost. If you have a $10 million building, the carrier is going to pay $10 million if it was a total loss. An extended replacement cost, and only certain carriers can offer this, is going to, the value on your policy will still say 10 million, but the carrier will pay up to 125% if there is a total loss. So if you have a $10 million building limit and you have we call it ERC, extended replacement cost endorsement, the carrier will actually pay up to 12.5 million in case there was any discrepancies between that $10 million being enough. Yes, yeah.
Great. What's your run loss reach back? Is it 3 years, 5 years? That's
Good question, yeah.
What's one question. The other one is, when you talk about betterments, and third one is, do you offer HO6 policies?
Okay, so loss history, that's a carrier requirement. So for example, Erie Insurance is going to want to see a 5-year loss history. That's what they require us to provide them with. Westminster American, they're going to require a 3-year loss history. Greater New York, a 4-year. So it's between 3 and 5. And when I'm brokering it, I'm asking, because when I'm seeing a community, I can see what type of construction they have, where are they, and I know which carrier is going to be the best fit. So I would say, all right, I think that this is going to be great with Erie. I need your 5-year loss history. If I'm doing them all, if I'm doing a widespread bid, I'll ask typically for 5, because I know That's the most, and you're not gonna go back, the manager's not gonna go back to the current agent and say, I want one that says 3 years, one that says 4, and one that says 5. Regarding betterments and improvements are always gonna be wanted to cover under your HO6 policy, that unit owner should be having their own betterments and improvements coverage. And, you know, it should be required that they have that, to be honest, because that shouldn't be on the community association to insure, right? If Unit A has a gold chandelier and marble countertops, and Unit B has the standard build that wasn't that, you know, that shouldn't be on the community to replace those marble con. It should be what was the original build. As for HO6 policies, Sahouri Insurance does not offer HO6 or personal lines policies at this moment, simply because of the quantity.